Hi guys, I hope you are doing well today. Welcome to this first class of the lesson Fundamentals of Technical Analysis, the best class for becoming a profitable trader from scratch. Today, let's see a quick introduction to technical analysis and understand why it works. Yes, you will find here the content disclaimer. The learning objectives of these courses are, first of all, to introduce trading and technical analysis. You will understand the difference between fundamentals and technical analysis. Then we're going to see background and charts, all the different charts, patterns, all the different trends with support and resistance, and of course, how to interpret candlestick charts. This will be followed by indicators, the popular ones, and we're going to learn how to create our own indicator by combining two or more indicators. Then, some theories with Dow, Elliott, Fibonacci, and cycles. Finally, we will see psychology and understand how to be a profitable trader. Okay, today we will talk about the global idea of trading. Then we will understand what fundamental analysis and technical analysis are, why technical analysis works, and finally, a quick review. So, what is the concept of trading? It's very simple. We want to buy something and sell it later at a higher price. That's it. It's the same concept as most businesses in this world. In trading, we can buy stocks, bonds, cryptocurrencies, cash, commodities like gold, oil, gas. Yes, you understood right. We can trade everything. This idea appeals to a lot of participants in the market. It's a very competitive sector because it's you against all the other traders in the world. You are alone against the rest of the world. So you will ask me, how can I be the best? I will answer you by having access to the right information at the right time. It's the concept of fundamental analysis. This term is the same as information. So let's start with a quick definition from ChatGPT. Fundamental analysis is a method of evaluating the intrinsic value of a financial asset by analyzing the information related to economic, financial, and qualitative factors that impact its performance. Yeah, I agree it's a very boring definition. Let me clarify. First of all, let's talk about the price to earnings ratio, also called the PE ratio. It's the share price, the price of the stock in other words, divided by earnings per share, the profit per stock. Fundamental traders really like to look at this indicator. If the PE ratio is under 10, the stock could be underestimated and it could be a great time to buy. On the other hand, if the PE ratio is above 17, the stock could be overestimated and it could be a great time to sell. This strategy is used by long-term investors and allows you to earn some money based on the earnings of a company. But there are two problems. The first one is that it's only a long-term strategy, and the second one is that everyone has access to the financial statements of a company. So you finally know what everybody knows, and it's very difficult to earn money with that. For example, everyone has access to the financial statements of a company, GDP of countries, inflation data, the halving date for Bitcoin, in other words, public information. To know what everyone knows is to know nothing. You don't have an edge on the information by knowing that. If you want to have an edge, you can, for example, buy a satellite in space. Yes, you heard right. That's what banks and major hedge funds are doing. They are counting the number of cars in Walmart parking lots to predict if there are lots of sales today. And a bank did that during one quarter every day to have an edge. They discovered a decrease in Walmart car counts at US locations in 2018. And look at the chart. The price was down during that period, so the bank was able to know before everyone else that the quarter was not a good one for Walmart, and so they shorted the stock and earned a lot of money. It's crazy. There are other means to have an edge on information. For example, Warren Buffett looks at freight train loads as a way to track economic flows. He is able to predict the future of the US economy just by looking at freight train loads. You can also talk with C-level executives of companies to try to understand their financial projections and get information that other investors don't have. And finally, you can track credit card transactions to know if retail customers are spending money and anticipate the economy. I agree. It's crazy, and as retail traders, it's not possible for us to buy a satellite to watch parking lots. Unless you have millions of dollars to spend to get access to the right information, which I don't think you do. So how can we make money in financial markets? It's simple, just by looking at the chart and only the chart. That's the principle of technical analysis. The technical analysis aims to follow people who have the right information. It aims to follow the guy who knows the number of cars in a parking lot. So let's start with a quick definition of technical analysis. Technical analysis is the study of historical price movements and trading volumes to predict future market trends and make informed trading decisions. It's less boring than the previous definition, but let's clarify this together. We can see in this chart a huge movement here. In fact, it's a fundamental news about the Australian employment rate. The rate was released and the news was bullish. A lot of hedge funds bought just here. As a retail trader, we can try to make something very simple. Just follow the insiders. So, for example, if we enter the position here, it was totally possible to make money. It's a very beautiful trade, as you can see. So, you have to understand that the chart tells you everything. It's the efficient market hypothesis. All information available is plotted on the chart. You don't have to buy a satellite to be profitable, just look at the chart. A quick overview of technical analysis. The study of price action is based on 4 premises. The first one is market action discounts the future. It's possible for you to predict the price by looking at past chart data. The second one is prices move in trends. Tomorrow will probably be like yesterday, in other words. Then history repeats in a general manner. When there is a bubble, a crash is inevitable after that. And the last one is human behavior is at least somewhat consistent over time. It's always greed followed by fear. What we'll do in technical analysis is study the chart to find patterns like this one, the symmetrical triangle. We will use indicators to spot trends, like the chart on the right. We're going to study cycles to find a point of change. And of course, the most important is to find support and resistance levels. Some key concepts here. The theory that investors like to be even creates support and resistance. In fact, you can see in this screenshot that the price rebounded at the bottom and upper lines. It's because a lot of traders open positions here, and they like to be even if the price doesn't move in their favor. The importance of market liquidity for applying technical analysis. The more liquid a market, the better technical analysis works. A good trader is wrong 50% of the time. That doesn't stop them from being profitable. And finally, technical analysis is based on the law of supply and demand, which is the basic law of economics. Why does technical analysis work? It's very simple. Just follow the rules. In fact, technical analysis is binary. It's 1 or 0. It allows you to create strategies that send buy or sell signals, and you just have to follow these signals. Of course, great discipline is required to succeed. It's the major difference between a profitable trader and a loser. Technical analysis works because the price reflects all available information and because many participants make decisions based on emotion. Our decisions should be based solely on the shape of the graph. We don't have to look at parking lots or other crazy information. Everything is on the chart. Let's talk now about the turtle trader legend. Richard Dennis, this guy, or goat I should say, is a successful trader. He and William Eckhart held the turtle experiment to prove that anyone could be taught to trade. By the early 1980s, Dennis had turned an initial stake of less than $5,000 into more than $100 million. Dennis believed anyone could be taught to trade, while Eckhart countered that Dennis had a special gift that allowed him to profit from trading. Dennis would find a group of people to teach his rules to, and then have them trade his ideas with his money. The training would last for 2 weeks and could be repeated over and over. He called his students turtles, after recalling turtle farms he had visited in Singapore and deciding that he could grow traders as quickly and efficiently as farm-grown turtles. Dennis placed an ad in the Wall Street Journal, and thousands applied. Only 14 traders were accepted. No one knows the exact criteria Dennis used, but the process included a series of true or false questions. And guess what? All his students multiplied their initial stake by 8 in 5 years. It's a crazy return. Let's see 4 of the questions that Dennis sent to his students before recruiting them. The big money in trading is made when one can get long at lows after a big downtrend. True or false according to you? It's a test for you. Try to know if Richard would hire you. Second question. It is not helpful to watch every quote in the markets one trades. Then, others' opinions of the market are good to follow. And the last one. On initiation, one should know precisely where to liquidate if a loss occurs. So, what do you think? The first one is wrong. It's possible to make money all the time. The second is right. The third is, false. Your strategy is better than everyone else's opinion. And finally, the last one is right. When you enter a position, you have to know at which level you will exit the position. It's very important. A quick review of today's course. To know what everyone knows is to know nothing. You know nothing. All information is displayed on the chart. It's the efficient market hypothesis. The more liquid a market, the better technical analysis works. Anyone can learn to trade profitably. The turtle experience just proved it. You also have to understand that technical analysis works very well with some fundamentals. You can be a news trader, for example, and use technical analysis to benefit from the news. The best combination for me is technical, fundamental, and quantitative analysis. Okay guys, thank you for joining me. If you liked the video, please subscribe, like, and see you in the next class.